The RBI's financial stability report just came out a short while ago, which certainly raised the red flag when it came to the overall risks to the banking sector. Anirudh Ghosh joins in with a detailed perspective of all that was outlined in the report. Anirudh.
Certainly, Avan, as you mentioned, a number of red flags being raised by the RBI. A few of them not very new, a few of them completely new as far as banks are concerned, and the concerns emanating from these issues are concerned. So now, just to look at a couple of issues. Firstly, the asset quality piece. The RBI has been talking about this time and again. Remember, they also put out a discussion paper recently about the early detection and resolution of NPAs. So, of course, that's something that we already know that the RBI is very concerned about. But they've actually conducted their stress test. Remember that this is a biannual activity which the RBI is going to be doing on a prolonged basis from now on. And, of course, they found out that if the current situation persists for quite some time, the asset quality concerns aren't going to go away anytime soon. They're also expecting that in the baseline situation, the asset quality piece could actually worsen to a gross NPA level of 4.4% for the entire system. On the other hand, if the situation worsens significantly from here on, and the worst case scenario really is that the asset quality would actually get worse to the impact of about 7.7% as far as the gross NPAs for the system are concerned. And this, of course, is something that is a very alarming situation. But, of course, they also do mention that even in this situation, the credit quality of the banks would still remain under check, given the fact that the capital adequacy of banks is going to be well above the 11% mark, even if there's an extreme stress situation. They've also, of course, pointed out a couple of other risks. Firstly, the fact that large corporates are borrowing from a number of banks, and a number of banks have exposures to a few large corporate groups. Of course, that is something that's a big concern as far as the RBI is concerned. They've also spoken about how these large corporates, if at all there is a failure of a large corporate, it could have a far-reaching impact as far as the entire banking sector is concerned. And last but not the least, they've also spoken about how a number of banks have been writing off a number of accounts, and that's been the reason why we've seen a few banks reporting lesser NPAs. So while they say that writing off NPAs could be good as far as the prudential guidelines are concerned, it could be a good thing, a good way to actually ensure that the tax implications are lower for these banks. It's something that the RBI wants the banks to be very judicious on, and they've actually warned that banks boards need to take a closer look as far as these write-offs are concerned. But overall, a very grave picture being painted by the RBI. But of course, they're saying that things aren't as bad as a systemic risk, and of course, they could improve going forward if the economy does improve overall.